Good evening and welcome to our today's session. We are going to be looking at marginal and absorption costing, and we just want to expound a bit about these techniques, which are basically used by the management to report some profits within the organization. So basically, when we are looking on the marginal and absorption costing, we are looking only techniques which are used by the management to report profits. And they are normally differ in the valuation of the products. Let me just write that here. They normally differ. They normally differ in the valuation. They normally differ in the valuation. They normally differ in the valuation of the products. The valuation of the products, especially they normally define the valuation of the product, especially the fixed production overheads. The fixed production overheads. So it means that the marginal and absorption costing, there is one which normally recognizes the availability of the fixed cost. There is another one which does not recognize or does not factor the fixed production overheads as a relevant cost. So that is the difference between the two. So when we look, for instance, like marginal costing, let's start with marginal costing. It is normally called also variable costing. It is normally called variable costing. It is normally called also a direct approach or direct costing. These are the names which examiner is going to be putting in place. Let me just work on this camera to look better, please. So when we look on it, we have said that one of these techniques normally recognize the availability of the fixed cost, the fixed production overheads, whereas the other one does not recognize the availability of the fixed cost. And in this case, we are saying, according to this technique, so according to this technique, we are saying the cost of production normally constitutes the variable cost components. So it means when you are preparing your income statement, it means the marginal costing does not recognize the fixed production overheads. And that is why it is normally basically called the variable costing, because it basically captures the variable cost only. So in this case, we can be able to give some examples here. We are saying direct materials. We are talking about direct materials. We have direct labor. We can talk about direct expenses. And also we normally talk about variable production overheads. Now, in this case, we know very well, because we are going to be preparing something called product cost. So every time we are going to be doing the marginal costing, the first thing that we have to be doing is to come up with a product costing, right? And then we have 10 shillings here. So it means I have to be doing the variable cost per unit, right? The production cost per unit. So in this case, we are going to be factoring direct material. We are going to be putting it there. We have direct labor. We put it there. We have direct expenses. Right? We put it there. Then the last one, we have a variable production overheads. Then you put it there, right? Then at the end of the day, you're going to be getting the total product cost per unit. The total product cost per unit. That is what you're going to be getting there. The total product cost per unit. That is what you are supposed to be getting at the end of the day. Now, there is the calculation of the income statement now. Income statement format. The income statement format, you're going to be having two Kenya shillings, two columns, right, denominated by Kenya shillings. So you're going to be starting with sales. Our sales, we put it there, right? Then we less cost of sales. You know very well that we normally start with the opening stock. Opening stock, which you're going to be putting it there. Then, rather than factory purchases, we normally replace this with production. We put it there. Then we less the cost, the closing stock. We let the closing stock, we put it there. Then at the end of the day, you're going to be getting the total cost of sales. Then we subtract there and get the gross profits. You get your gross profit there, right? After you get your gross profit, you just need to subtract your non-manufacturing costs. So you can talk about less non-manufacturing costs. We less non-manufacturing costs, right? We normally discuss about here, we normally factor something called variable selling costs. Variable selling costs, you put them there, right? The variable selling costs, you're going to be putting them there. Then we are going to be, because we are subtracting it, right? Let me just put it there. We are going to be getting our net contribution. We're going to be getting our net contribution there. Then from there, factor of fixed costs. Let us less the fixed production overheads. You put them there, right? The fixed production overheads. The fixed selling costs. The fixed selling costs, you put them here. Then the other one we are discussing about the fixed admin. The fixed admin cost, we put them there. So at the end of the day, you get your totals for the fixed costs. Then you are going to be getting your net profits. Your net profits, you get it there. That is your net profit. That is your net profit. So at the end of the day, some certain student might be asking, why is Mwalimu factoring the fixed production cost here, whereas he has said that it is not factored when you are calculating the marginal costing. The fixed production cost is not captured per unit when you are doing the product costing for the marginal costing, right? This one is not factored per unit. It is not factored per unit. So that is the difference. You don't put it here when you are doing your product costing, but you can be able to less it under the, you can be able to less it when you are doing your income statement. Let us look on the absorption costing. Absorption costing, right? Let us look on the absorption costing now. Absorption costing. Now, in this case, when you're looking on the other side of the absorption costing, it means it factors the fixed production overheads per unit when you are calculating your product costing, right? We are talking about absorption costing, right? So let me just go straight away because I'll be able to share the notes for you because already you have known the difference between the two methods. When I look on the product costing, under the absorption costing, you're just going to be having your columns of Kenya shillings there. So we normally factor the direct material. We put it there. We have direct labor. You put it there. Then you have direct expenses, if any, you put them there. Then we have variable production overheads, you put them there. Then the last thing that you're going to be factoring in is normally called the fixed production overheads. And remember, should be per unit, because here we normally calculate the product cost per unit. We put it there. We put it there. That is what you're supposed to be getting. Let us look on the income statement now. Income statement. Income statement format. So in this case, when we're looking on the income statement format, we have a column of Kenya shillings, right? So we start with your sales, right? You put them there. Then you have, you less your marginal cost of sales. We start with the opening stock. Opening stock we put there. Then we have your production. My production is there. Then we less our closing stock. Right? You get your total cost of sales. Then you get your gross profits. So your gross profit is not there. Then we are going to be factoring something called here overstock under absorption of overheads. So we are going to be looking on overstock under absorption. Right? If it is over absorption, we are going to be adding. And if it is under absorption, we are going to be subtracting. You're going to be subtracting there. Then the other thing that we have to be looking here, we less operating expenses. Operating expenses, right? The differences between this income and the other one, it is over and under absorption, right? The second thing will be, we don't factor the fixed production overheads again here, since it is already absorbed to the units produced, right? It is already absorbed in the units produced. So when you're going to be lessing your operating expenses, you just factor the other costs. For example, we can start with a variable selling cost. You put them here. Then the other one, we can talk about the fixed selling cost, which you can also be able to put there. Then you can talk about the fixed admin expenses. We put them there. The fixed admin expenses, we also put them there. So in this case, once I get my my operating expense total, then I'm going to be subtracting it directly, and I will be able to get my net profit. My net profit now, I can be able to get it there. My net profit, I can be able to get it there. Now, after doing this, I can be able to do something called reconciliation statement. Reconciliation statements. You need to reconcile your statement and be able to get some of the answers which you are able to get when you're using the two methods. So let me have Kenya shilling here and another one here. So we normally do by taking, you can say, let me take the profits as per absorption. The profit as per absorption is the one that already you have gotten here. So we put it here. Then after getting that profit, we are going to be adding overstated. We add our overstated opening stock. Right? We had overstated opening stock. We less overstated. Less your overstated closing stock. We less our overstated closing stock. What we're supposed to be getting there should be the profits as per marginal. Profit as per the marginal, you put it there. The profit as per the marginal, you're going to be factoring it there. There is a question which I have shared in our WhatsApp group. There is a question I have shared there. May 2015 question 3B. I just want to start by doing that question. May 2015 question 3B. Let us start from there. I hope you can be able to see my question. Someone read for us, please. Someone read.
XYZ Limited has provided the following details for the month of April 2015 in respect of production and sales. Sales 10,000 units, production on 12,000 units. Cost data per unit of output. Selling price 1,000, direct material 360 shillings, direct labor cost 80, variable production overhead 60. Other costs, fixed production overheads 1,980,000, fixed selling expenses 300,000, fixed administrative expenses 500,000. Additional information: variable selling costs are 10% of sales. Normal production capacity is 11,000 units. Required income statement for the month of month ending 30th April 2015 using marginal costing. Scroll. And absorption costing.
Thank you so much. You can see how the question is basically given. The question we are being told that we have the sales 10,000 and the production we were able to produce more than what we sold. When you look on the cost data per unit of the output, we are being given the selling price per unit. We are being given the direct material costs, variable costs, and we have the labor cost there. Other costs given, we have the fixed production overheads, fixed selling expense, and then we have the fixed admin expense. So additional info given in the question, we have been told that the variable selling costs are 10% of sales, and then the normal production capacity is 11,000. So the normal capacity, it means regardless someone is requiring you to someone needs for example 2 units, you have to produce 11,000. That is your minimum and the normal production capacity of the organization, 11,000. We cannot be able to produce less than that. So in this case, we are going to be comparing, when we are going to be doing an overstock and absorption, like in this case, you can see what you are able to produce. You produce 12,000 above our normal production capacity. And this, it means that it is our over absorption. Look on the 12,000, and then you can see the normal production capacity is 11,000. There is another question which we shall be able to do, and the examiner has not given the normal production capacity. So when the normal production capacity is not given, then you are not going to be doing overstock and absorption of the overheads. And don't say that the question is wrong. No. Now, when you move on checking the question, you will be able to see that when you are doing the product cost, we have said when you are dealing with the marginal costing as per the requirement part 1, we cannot be able to factor the fixed production overhead. So what are we supposed to be doing? Let's go back to my board and we see it. So in this case, when you are doing your question, you start with the product cost, as I have already stated earlier. So in this case, let's start by checking the the cost per unit given, and I can see examiner has given me direct material. So direct material is already given and equals to 360. We have direct labor, and the direct labor given in the question is 80. And then we have variable production overheads given as 60. So this comes to around 500. Right? Now, when I start by doing the income statement, when you are using absorption costing, marginal costing. So I just say I have to be having 2 columns of Kenya shillings like this. Then we are going to be starting with our sales. So our sales, we are being told 1 unit is being sold at 1,000, right? And we were able to sell 10,000 units as per the question. This equates to 10 million. 10 million there. Then we have something called less the cost of sales. We are going to be starting with the opening stock. As per the question, the opening stock is not available, so it is not there. The opening stock is not there. We have production, right? The production aspect, we are being told we produced 12,000 units, and you have already calculated the product cost per unit, which totals to 500. So I just need to multiply here with 500. And this comes to around 6 million, right? Then we let the closing stock. The closing stock normally arrives from, we were able to produce 12,000, but you sold 10,000. So the closing stock, it means, is 2,000, right? 2,000 is our closing stock because you are able to sell 10, and remember you produced 12. So the difference is 2,000, which becomes your closing stock. You just multiply with 500. This comes to 1 million, right? How much are we getting here? Is 5 million. What is your gross profit? My gross profit will be 5 million. The gross profit will be 5 million. Now, let us less non-manufacturing. Non-manufacturing costs. Let us less non-manufacturing costs. And when I look on this question, we are being told, under the additional information number 1, you are being told the variable selling costs are 10% of sales. Variable selling costs. The variable selling cost is 10% of your sales, total sales, which is 10 million. So this comes to 1 million. So the net contribution, our net contribution is 4 million. That is our net contribution. Now let us less our fixed costs, right? We less fixed costs, and the examiner has given us 3 fixed costs there, right? The first one is the fixed production overheads. The fixed production overheads, we are being given 1980,000. We have the fixed selling expenses. The fixed selling expense amounts to 300,000. 300,000. Then we have the fixed admin. The fixed admin expenses amounted to 500,000. What is the total here? 2780. What is your net profit here? What is your net profit? What is your net profit here? My net profit, when I look on the difference, 4 million minus 2780, I should be getting 1220,000. 1220,000. That is my net profit. That is my net profit. That is my net profit when I'm using the marginal costing. When I'm using the marginal costing. Now let us go to the second requirement. Examiner wants you to get absorption. Absorption costing. And it is also very simple. You're going to be start by looking on the product cost per unit. So nothing much is changing. You start with the direct material. Your direct material amounts to, we say 360. Direct labor amounts to how much? 80. Then we have variable production overheads. The variable production overhead is 60. Then we have the fixed production overheads, and it should be per unit. But what I can see, examiner has given you the fixed production overheads is 1980,000. The question will be, how am I going to be getting the fixed production overheads per unit? I will be able to tell you, I always take the total production overheads, the total fixed production overheads, the total fixed production overheads, you divide by normal production capacity, the normal production capacity. That is what you're supposed to be doing. The total fixed production overheads, you divide by the normal production capacity. I can see the total production overheads given by the examiner is 1.98 million. Then you divide by the normal production capacity, which is given as 11,000. Which is given as 11,000, right? How much is the fixed production overhead per unit? How much is this? Let's take a calculator. So you can see there, we should be getting around 180. 1980 divided by 11. I'm getting 180. So my total translates to 680. 680. That is the product cost per unit. That is my product cost per unit. Now, after getting that, just start your income statement straight away. Nothing much is changing. Nothing much is changing here. So you're going to be starting with your, I'm saying that you have to be coming up with income statements. We are using absorption costing, right? You're supposed to be using the absorption costing there. You are supposed to be having also 2 columns of Kenya shillings. We start with our sales as usual. Our sales will be 10 million, nothing is changing there. Let us go to the cost of sales. We start with the opening stock, which is not there. We don't have the opening stock, but we go to the production. I said we produce 12,000. Then the cost per unit now turns to be 680. 680 there. So 12,000 times 680, you are getting how much? You can see we are getting 81,60,000. Then we less our closing stock. We are talking about 2,000 multiplied by 680, right? 2,000 times 680. We are getting 1,360. Right? What is our cost of sales? 81,60,000 minus answer, getting 6.8 million. What is our gross profits? What is our gross profits? 10 million minus my answer, getting 3.2 million. We said here, after we get our gross profits, let us factor our overstock under absorption. And this one we said, it is normally the comparison between what we have produced, actual production capacity. Then we subtract the normal production capacity. Right? I have said you just need to be factoring between the actual production capacity, right? The actual production capacity minus the normal production capacity. Now, in this case, you can see in your question there, right? The actual production capacity we produce 12,000, right? Then the normal production capacity of ours is 11,000. The difference is 1,000, which is normally called over absorption. Remember, we produce more than what we normally produce. That is our over absorption. So I just need to take 1,000 here. Then I multiply it by, right, the fixed cost per unit, which is 180. Once you get the number of units, you normally multiply by the fixed cost per unit. This translates to 180,000. Right? Once you get that, you are going to be you are going now to be subtracting the operating expenses less operating expenses. Less operating expenses. And you're not going to be factoring the fixed production, right? No. We are going to be starting with the variable selling costs. The variable selling cost is per the question we were being told, or it was 10% of the sales, and we were able to get 1 million. Remember? Then you take the fixed selling expenses. The fixed selling expense was around 300,000. Then we have fixed admin expenses coming to 500,000. So it means the difference, right? The difference with the one for the marginal is the fixed production of overhead. So now we are supposed to be treating it. So this comes to 1.8 million. 1.8 million. What is your net profit here? The net profit, it will be 3.2 million minus 180. Sorry, it should be plus 180. Then we subtract 1.8 million, getting 1580,000. 1580,000. That is what you're supposed to be getting in the net profits. Now, after this, sometimes the examiner might be asking you this question to reconcile. That is why I've told you, you need to be coming up with the reconciliation statements. Reconciliation statement there. You're just going to be having one column of Kenya shillings. We start with the profit as per the absorption. Profit as per the absorption is 1580,000. Right? Then we have said add overstated opening stock, which we don't have. Then we less overstated closing stock. Our overstated closing stock there. How much is our closing stock here? Right? What is our closing stock? In this case, we know very well our closing stock is 2,000, right? Then you multiply by the fixed production overheads per unit, which is 180. Fixed production overheads cost per unit, we go to 180. This comes to around 360,000. Once you subtract, you're supposed to be getting profits as per marginal. Profit as per the marginal, you just take 1580 minus 360, getting 20,000. You're supposed to be getting 20,000. So if you reconcile and your question, right, your question does not reconcile, then there must be a problem. There must be a problem there. You must be repeating your question and you see the areas of concern. Any question? Cleophas, iko sawa?
Iko sawa.
Very good. So I just want to shift and do another question. December 2021. December 2021. There is a question there, question 3A. December 2021, question 3A. Hata na ujue hii hapa hawajaleta hii marginal and absorption sana, but it might be a target in the coming sittings. So let us go there. Question 3A, someone? Someone to read? Jacob? Jacob is not here with us. Jackson, sorry. Should be Jackson.
The cost accountant of ABC Limited has provided the following information relating to production of a single product, branded Z. There's period 1, period 2, and period 3. There's production in kgs for every period, sales in kgs for every period, opening stock for period 3, closing stock in kgs for period 2, additional information. The financial details for 1 unit of product Z based on a normal activity level of 30,000 kgs is as follows. Cost per kg, direct material 1.5, direct labor 1.0, production overheads 300% of labor 3.0, total cost 5.5. The selling price of product Z is 9 shillings per kg. Administrative overheads are fixed at 25,000 shillings per period, whereas 1/3 of production overheads are fixed. Required. Prepare operating statement using number 1, variable costing, number 2, absorption costing.
So let us solve this very quickly. I can see examiner is giving you good conditions there. He is saying, and the last thing is the one that differentiates your question. Now you can see number 3, examiner saying administrative overheads are fixed at 25,000 shillings per period, whereas 1/3 of production overheads are fixed. So it means the variable production overhead should be 2/3 if 1/3 is fixed. I think we're in agreement there. Now, let's start by working with our question. When you look on this question, I have not seen examiner giving you the normal production capacity, right? It is not there. So you are not going to be analyzing your overstock and absorption of overheads. That is the thing that you need to be understanding there. So let me go back and I give you the solution. Right. So in this case, we're going to be starting by looking on the product cost per unit, right? When you are using the variable costing or the marginal costing. So when I look on my additional information number 1, I can see examiner there giving you the cost per unit, per kg, sorry. So in this case, examiner has given me direct materials. Our direct materials equals to 1.5. Right? We have direct labor. Our direct labor is per the question. We have been given 1 shillings. Then I can see we have the variable production overheads. The variable production overhead should be how much? I can see there we are discussing about 1/3 of the production overheads are fixed. So we are discussing about 2/3 being the variable. 2/3 of 3, right? 2/3 of 3. How much are we getting here? Should be 2. right? So how much is the the product cost per unit? So this one should be equivalent to 4.50. 4.50, because we have been told one third. You're going to be factoring that later. Now, when we're discussing about, we are starting with the variable costing, so we come up with the income statement. The income statement there, right? So we are going to be having 3 periods. We have period 1. We have period 2. Then we have period 3. We have period 1, period 2, period 3. Now here we have Kenya shillings. We have another Kenya shillings here. Kenya shillings. We have Kenya shilling there. Kenya shillings. Kenya shillings. Right? I think it is okay now. Then it means I'm going to be starting with my sales. Sales. Right? So my sales will be equal to how much? When I look on my sales there, examiner has given you some sales in kgs. So the sales in kgs, we are given how much? I can see for the first period, we are being given 30,000. I multiply by the selling price per unit. I can see under note additional number 2 is 9 shillings. So in this case, it means the first one will be 270,000. Right? That is for the first period. For the second period, I can see we were able to sell 27,000. You multiply by 9 times 9, coming to 243,000. Then we have the third one, which is 38,000 times 9, getting 342,000. 342,000. Let us less the cost of sales. And you're going to be starting with the opening stock. The first one, we don't have the opening stock. Since I can see even the examiner is telling you is dash, we go to the production. We were able to produce, right, 30,000 again. Then you multiply by 4.5. 4.5. 30,000 times 4.5. We are getting 135,000. Then you go to the closing stock. The closing stock we don't have. The closing stock we don't have. 1 minute. Now, thank you. Let us move on. When I look on the cost of sales under the period 1, right? I have 135,000. So, wewe hata una haraka unakuja unaniambia, waje nipate the gross profits for the first period, 270,000 minus 135,000, I'm getting 135,000. Right? Then it means the closing stock for the first period becomes the opening stock of the second period. So in this case, it means still our opening stock is not there. It is our dash. Then when you go to the production, you look on period 2, you are able to produce at 8,000 times 4.5. Here we get 171,000. Right? The closing stock is how much? You produced 38,000, you sold 27,000. What is the difference? I can even see examiner giving you there 11,000. So it will be 11,000 here, then you multiply by 4.5, getting how much? 11,000 times 4.5, getting 49,500. 49,500. So it will be 171,000 minus your answer, getting 121,500. 121,500, right? So the first one will be 243,000 minus my answer, getting 121,500. 121,500. You know very well that the closing stock of the second period becomes the opening of the third period. So how much will be our opening? You tell me it will be 49,500. 49,500. What will be the production? And I can see in the question, the production will be 27,000 for the third period. So 27,000 times 4.5, getting 121,500. 121,500. Then you go to the closing stock. I think we are flowing. Is the question okay? Jackson, is it okay? I have said very well. The production is 135,000. The closing stock for the first period is not there. So the cost of sales for the first period is 135,000. The difference between 270 and 135, you get 135. Now, when you go to the period 2, the closing stock in the first period, which is dash, because the opening in the second period, which is dash here. Then the production, you are able to produce at 8,000. You multiply by the production cost per unit, which is 4.5, getting 171,000, right? Now, when I look on the closing stock for the second period, we are being told I was able to sell, I was able to produce at 8,000. I sold 27,000. Even the examiner may calculate here pale. Closing stock for the second period is 11,000, right? So 11,000, you multiply by 4.5, getting 49,500. 49,500. 49,500, right? Then when you look on the differences by calculating the under the period 2, we calculate the cost of sales. You just take 171,000 minus 49,500, getting 121,500. So the difference between 243 and 121,500, you get 121,500. Now let us go to the third period, and which is our last. We know that the closing stock in the second period becomes the opening of the third period. So the 49,500 you just carry out to be the opening stock of the period 3, right? Then when I look on the production, you can see you are able to produce 27,000. 27,000 times 4.5, getting 121,500, right? Then I can see under the period 3, right? Under the period 3, we did not have the closing stock. Why? Remember the units that we were able to generate, the unit that we were able to open with here is 11,000. You produce 27,000, and when you look on the third period, you are able to sell 38,000. So it means you don't have the closing stock. So it will be 121,500 plus 49,500. We are getting 171,000. 171,000. 171,000. And when you look at it, it also means here the gross profit will be 171,000. 171,000. I think at that point it is okay, right? That one is okay. Now, when I look on the question given there by the examiner, he has not given us the variable selling cost. It is not there. So you cannot be able to do it since it is not in the question. What do we have? I just come here and I say, let me less my fixed costs, right? I just need to less my fixed costs. I start by deducting the admin, the fixed admin costs. The period 1 I can see examiner is telling you is 25,000. Period 2, 25,000. Period 3, 25,000. 25,000. What about the admin production costs? The admin production costs. I can see examiner telling you it should be a third of the production overhead, which is 3. So a third of that is 1 bob, right? So if I take the production, units or kgs which we produced, we multiply by 1 shillings, right? Because we have said the fixed production overhead should be a third of 3, getting 1. Then you multiply by the production units there up. I can see the first one will be 30,000, right? The second one will be 38,000. Then the last one will be 27,000. Good. So what is my profits? Here you can see we have 55,000. We deduct. Here you can see we have 63,000. We deduct there. Then here I can see we have around 52,000. You take your deduction there and you get your net profits. We get our net profits. Where am I getting this 30, 38, and 27? I've said the fixed production overhead per unit is 1. Then you multiply by the number of production kgs given in the question. So it will remain the same, 30, 38, 27. That is okay. So in this case, 135 minus 55, we are getting 80,000. The second one will be 121,500 minus 63,000, getting 58,500. Then we have 171 minus 52, getting 119,000. Getting 119,000. Any question, Teresia?
I didn't understand the last part. The last part, that is fixed admin.
Sorry, this should be fixed. Sorry, fixed production.
That is fixed production, which was a third of 3.
A third of 3, which is 1 bob per unit.
Then you
multiply by the number of units you produced. Like the first unit you produced 30,000. The other one you produced a certain amount there.
Okay.
Is it
No,
okay?
I get. Yeah.
Now I just want us to do absorption. Absorption costing.
And you're too fast.
Okay. You want to copy?
Yeah.
And one is writing.
We are writing.
Okay, we can write. We give you 1 minute. So let us proceed and do we do our absorption costing. Absorption costing. So what am I supposed to be wrapping? I just need to wrap this place. Where you can write all the areas, right? And then also I'm going to be doing my adjustment here. So what I really know is that I'm doing absorption costing. The requirement part 2. Absorption costing. And in this case, we are looking on the variable production overheads. We said it is 2. The variable production overhead was 2. Then we have the fixed production overheads will be 1, because already you know the total of the variable and the fixed was 3 shillings. So the variable production overhead is 2. The fixed production overheads we know is 1. So what is our total here? This is 5.5. 5.5. So let me just, because the income statement on the side of the sales seems it looks the same. So let us less, right, our cost of sales. And I start with the opening stock. So our opening stock for the first period is not there, right? Then we go to the production. You ask yourself, for the first period, you are able to produce 30,000. We multiply by 5.5. So 30 times 5.5, we get 165,000. We know very well we don't have a closing stock. Our closing stock there is dash. So how much are we getting here? We are getting 165,000. What is our gross profits? Our gross profit there is how much? 270,000 minus my answer. You're getting 105,000. 105,000 there. So you know the closing stock for the first period becomes the opening of the second period. In our case here, we don't have anything. How many units did we produce in the second period? You can see we produced enough. We produced around 38,000. So that 8,000, we multiply by 5.5. We are getting 209,000. 209,000. What is our closing stock? I can see our closing stock is 11,000. In this case, we multiplied by 5.5. So it will be 11,000 times 5.5. This will equate to 6,500. So how much is this? So 209,000 minus answer, getting 148. 148,500. 148,500. So 243,000 minus my answer, I'm getting 94,500. 94,500. Now, when you go to the third period, you know the closing stock in the second period becomes the opening in the third period. This is 6,500. How many units did we produce? I can see in the question we produced 27,000 times 5.5, getting 148,500. Then we have our dash there. So what is our closing stock? So our closing stock is 6,500 plus my answer, getting 209,000. What is your gross profits? 342,000 minus answer, getting 133,000. I said, because we said in this case, we are not given the overstock under absorption of overheads. Right? It is not there. So the overstock under absorption of the overheads is not there. So you just go straight away and you subtract with less.
Excuse.
Yes.
I have a question on the additional information 1. The following details for 1 unit of production is it based on normal activity level 30,000 kg. Isn't that the normal production?
Oh, yes, yes, it is. Thank you. Thank you, thank you.
So the resolve I want.
Let me check. The overstock under, yes. Let me check. The first one should be, we're able to produce 30,000. Our normal production capacity is 30,000. The production capacity of the first period is 30. I think that one we have dash here. Then when you go to the second one, I can see we have, we were able to produce 38, right? Whereas our normal production capacity is 30,000. That translates to 8,000. It should be 8,000, right? So 8,000 you multiply by 1, getting 8,000. Getting 8,000 there. Then when I look on the last period, which is 27, so it should be 30 minus that, getting 3,000. Or 3,000 times 1, you get 3,000, but should be under absorption. That is okay. Then we less our operating expenses. We less our operating expenses. So in this case, we are being told here, right? Our operating expense, we have admin expense, admin production. And it should be admin fixed costs. We are being told is 25,000 for each. So here is 25,000. And also here is 25,000. Then the last one would be 25,000 there. 25,000, right? And because, by the way, I don't have any other fixed costs, I just need to be subtracting 25,000 direct. So the first one is 25,000 here. Because we don't have any other costs, 25,000. Here we have a deduction of 25,000. 25,000. So we have 105 minus 25, we get 80,000 here. These are our net profits. The second one will be 94,500 plus 8,000 minus 25,000, getting 77,500. Then the last one we're being told is 133,000 minus 3,000 minus 25, getting 105,000. 105,000. Any question? Is it okay?
It's okay.
Tim, is it clear?
Yes, it's clear.
Okay, thank you. So the assignment which I will be able to give you here is for you to go and reconcile the absorption with the marginal, and we look on whether we can be able to get the same answers. Then when we are meeting next, we are going to be doing the application. We're going to be doing application of marginal costing. Application of marginal costing. And a lot of questions are coming from this area, right? Application of marginal costing is the next place, is the next stage where we should be working on over the weekend. So if we don't have any other question, we can stop at that point and see you next time. Bye-bye.